I'm still muted. How's everyone doing? How is everybody doing? Let me know how the mic sounds. I'm gonna wait a little bit, listen to some music. We're gonna invite Mr. Rags to Riches. So give me a second here, guys. Listen to some music while you're at it. Let me know what you guys think. Let's all get warmed up here. But then I ain't never fucking going past baseline, man. Give me y'all need mask. Little more balance and a lot of bit of can. Pull into the belly, get these motherfuckers can. Pull into the lunch, I gotta make it like a man. When I put them on the mother. Same old J, smoke more J, still make dumb plays, but I play less game. I'm ready for the war. Let's go. That's right. We're here. We're live. Look at Bitcoin on the hourly. Copy that address. We're gonna invite Mr. Rags to Richard here. And these motherfuckers say that we before they love it. And they still act like a name playing with their money. I told them take like to pay or something this money. For me on the bills because I ain't playing this. They ain't getting nothing. Even if they did, no, I wouldn't take it from them. If you guys like up the video, like up the live stream, share it to as many people as you can. Yeah, probably 25. That's what I'm expecting. That is what I am expecting. How's the mic, guys? Let me know in the chat. What's up, Yasmin? Sometimes this mic kind of cuts in and out, which gets a little annoying. And is the music too loud? Also, let me know. I'll turn I can turn the music down. So you guys let me know. This is Uncle Answers. This is a guy that I watched for some time. And then let me send this to Will. All right, let's see if we can find times at 1:54. Yeah, we still got a little bit of time there, guys. As well as hawkish news. Mike is good. Mike is good. I can hear you, Marty. Let's go. Man, how many people we got in here? We got 12 people, 14 people, guys. Let's like it up. Let's see. Fomc meeting, guys. Probably CNBC. It was 3 months ago. Come on. We'll find it. Kevin's doing it. Everyone's going live right now. I mean, it is a very big meeting. Oh my god, might have to be Google. Fomc meeting live. Uh 2:30, but I think it'll be on before that, obviously. Oh yeah, that's right. Yeah, they always announce it first. So what's up, guys? Good to see some old. Yeah, that's right. There's actually a lot of FS people in here, so make sure you guys show some love. Let's show some love here. Let's see, did Brandon join yet? Let me shoot another message. All right, he's probably about to join here shortly. And then I actually invited Will as well, so that's kind of the special guest appearance. But let's take a look at the Bitcoin really quick. Man, look at this. Let's just go on the 4-hour time frame. Got some order blocks here. Pretty crazy, huh? Pretty crazy how this has been playing out. This was, that FTX crash. Guess you could say it was kind of accumulation, right? Some slight accumulation. And yeah, then we had that crazy rip up. Now, this crazy rip up, a lot of people there's that conspiracy floating around where Forex Factory streams live links. Okay, cool. Let me as well, but I already found it. But it's always good to it's at 2:30. So, but we'll have Twitter up as well. Twitter's where obviously the FOMC announcement is going to happen. So I'm expecting 25. Oh, the Fed, does the Fed even? Oh yeah, the Fed does have their own admit. Boom. Brandon is here. And there he is. Brandon, how you doing? There's some
what is up, buddy? How you doing?
Good, man. I'm good. Just kind of getting the crowd warmed up.
Cool. We're actually going to have, not sure if you follow Will on Twitter. He's going to be joining as well.
Okay.
Yeah. So
how's the mic sound, by the way?
it's good, man. You're sounding nice and crisp.
Perfect.
But yeah, we actually got a decent amount of people in here. We got about 21 people already. So again, guys, like it up. If you're familiar with Brandon, make sure you guys, show some love. And, Brandon will be introducing himself shortly. Actually, Brandon, why don't you go? Why don't you introduce yourself really?
Yeah, my name is Brandon Davis. I've been in crypto since 2013. I am the co-founder of Texan Token, Texan.cc, and I'm a full-time YouTuber. I'd like to talk about all sorts of things, primarily macroeconomics. That really excites me, politics, and then all things related to cryptocurrency as related to macro stuff. So yeah, thanks for having me on, man.
For sure, man. Yeah, and just a quick disclaimer, guys. Me and Brandon, we're not affiliated anyway. We're just obviously supportive of each other. Actually, we'll be doing a deep dive into a Texan. I've talked to a Texan token. I've talked to a Brandon about it. So make sure you guys obviously sub and watching that. Let's actually take a look at a Texan token. It's been ripping like crazy.
Yeah, somebody set the initial price way too high, but yeah.
Let's because it's the wrapped ETH one that has
versus ETH. That's fine.
ETH, yeah.
Yep.
So there we go.
Yeah.
Token, man. Well, that's actually, this chart only goes back to February.
Yep, February. This is when I guess the ETH pair got created by somebody in the market. Yep.
Pretty crazy. I mean, geez. So since the 23rd, so basically in a month, 3.5x.
Oof. Yep, it's up about, I think it's about 650% since somewhere in January. So
wow,
it's doing real well. We got a good community, real strong. Yep.
Okay. Yeah. And then I made that TikTok about Hex.
Hex cool.
Is a complete tear. I mean, geez, look at this. Hex has just been on a complete tear. It's actually up like 5 or 6x since January, which is wild.
Yeah, man. People are trying to get that buy one, get one free because you get your Ethereum Hex copied over to the Pulse chain.
Exactly. So I think there's a video that was floating around that he might be like launching in like the next couple of weeks again, supposedly.
So V3, I'm part of some backdoor channels here and some chat rooms. V3 is about to be launched, which is huge.
Right, yeah.
And as soon as V3 launches, at any time, mainnet can launch. So very exciting.
Okay, awesome. Yep. Yeah. Again, I personally do want it to launch just so we can, start making some money, save some fees on gas. Granted, Ethereum gas isn't too bad right now. Like the average is like $10. But it's just the liquidity, and I know like there's like a lot that was sacrificed, it's like $1 billion worth, but when there's liquidity issues in the market, like the very bold time to be launching not only a new project, but basically a whole new blockchain and a whole new exchange at the same time, which is quite wild.
Here's some alpha that might help you set that at ease there. During the whole debacle with USDC, you saw one of the sacrifice addresses for Pulse chain kind of convert that into DAI, and they made a lot of money off of it. Now they're the #1 holder of DAI on the blockchain. That liquidity could potentially be used to bridge over into Pulse chain, which is really, really bullish. And that's what blockchains are all about. You're right. It's about liquidity.
Wow. All right. So it looks like they raised it by 25 basis points. Let's see how Bitcoin is reacting. Not surprising. I figured that they would actually, continue to raise rates. Let's actually do both Bitcoin and S&P 500 because that is what everybody has been expecting. Now, again, as we all know by now, or for those of you that, haven't yet figured it out, the announcement of the rate hike, it's always a lagging announcement because there's a small initial reaction, but the true move tends to happen usually a couple of days or a week after. A lot of people are expecting the Fed to pivot because of the whole entire banking crisis. And I saw that you were doing the videos, you're doing a live stream about it, chatting about, the implications of it and, what this means. But it's been very clear, Jerome Powell has said it multiple times that their main goal is inflation, right? They're going to do it by any means necessary. And they're not going to stop until they hit that 2% target. Now, I think we can all agree that it's probably not going to happen 2% anytime soon, just because of everything that's happening. There was, you even mentioned it where, we saw an uptick in their balance sheet of about $300 billion.
Right.
But it wasn't them actually printing money. They just basically bought short-term loans that are going to have to be, paid back.
Yes. Super cheap. And we've seen that behavior in the past. We saw that behavior in a window in 2008. We've seen that in 2020. One of the speculations that I have is they were doing that to pad the market for this announcement, just in case some narrative got spun up to make people panic. There would be extra liquidity for banks. And I think that's why they gave that money away so cheap last week.
Right. Well, the thing is, the last thing that we need right now is a massive run on banks.
Right.
Because again, inflation is so high, and now we're finally seeing the effects of raising interest rates for a whole entire year. Now we're actually going past the year since they officially decided to raise them even more. Now, there was another report I saw that basically, I think like SoFi, they increased their I think they requested to increase their FDIC insurance from 250K to 2 million, which is crazy. Let's see if I can pull that up.
Yeah, it doesn't surprise me. One thing too, let's check this. Let's see what it says. Yeah.
Wow, that's crazy. From 250K to 2 million. That is quite, that's a 10x, a little less than a 10x increase.
That's scary. I mean, what's that signaling to the market? What are they seeing right now? It could be a big issue for the big investors, and tweets like that and information like that can really scare the market. So again, I think that the Fed is doing everything possible to just make people feel okay. Now, did you see the announcement from the Federal Reserve website, a press release that announced the swap lines? Did you see that by chance? So you can do Federal Reserve, and then it should say something 2 days ago, the 19th. Central bank action to enhance the provision of U.S. dollar liquidity up. Coordinated. There you go.
Bank of Canada, Bank of England, Japan, and ECB, Federal Reserve. Yep, are announcing today a coordinated. Exactly. Yeah, I saw that. They're basically going to be commingling each other to provide extra liquidity.
Yeah, there's two key things here. So you think about run on banks at your local banks and your regional banks, okay? This is to thwart a run on the US dollar and other central banks across the world. So they do two things. They lock in the exchange rate, okay? And they inject extra liquidity into these other central banks. And this is kind of going along the premise and the idea that I had that they're trying to pad things in case there is a massive downturn. They're trying to be proactive, put liquidity in place so they have more of a wall to chew through instead of the bottom just dropping out. So I think this was huge too.
Oh yeah. It should, the sad thing is they start being proactive when crap hits the fan, right? Like they just start running around like cockroaches and saying, oh my God, everything's falling apart. We got to protect investors. We got to protect our depositors. Biden came out when SCBV is collapsing and saying, all depositors are going to be protected. However, investors are not.
Right.
which is very interesting because, again, a lot of these banks are not making money off of depositors. They're making money off of these investors.
Yeah. Making money off of it. They're leveraging up off of the deposits. And one of the issues that they ran into too, as well, is they will take the deposits. They'll get the 10x or 20x or 30x loan. So, $100 million turns into $1 billion. And then they use that and they actually go and they buy treasury. They buy treasury assets because that's guaranteed to get them, 5 or 7% return. When those go to heck, what are they supposed to do? It's just it's a house of cards here. They're running out of legitimate ways. And when I say legitimate, I'm talking about ways to be able to put a dent in the market. They're running out of ways to be able to control this inflation. And that's a really, really big issue. A small increase, you look back at the federal funds rate in the 70s, it's like 20%. You look at it now, it goes up to 5%. The world freaks out and economies crumble. What happens in 10 years when they raise it 1% and the world freaks out? So, it's a big type of issue that has to be solved here, especially moving forward in the future. This economic situation is pretty rough.
Yeah. Well, and again, we're not really even feeling the effects.
Right.
What's unemployment at? Let's take a look at unemployment rate. This is really the whole entire premise of what the Federal Reserve is trying to do. So at the moment, unemployment is 3.6%. I mean, we're still at lows.
They hate it. They hate that.
Yeah. But Warren loves it. She's like, why do you want to raise unemployment? Jay Powell, he stood his ground fairly well because, like he said, if we don't tackle inflation, this is going to be something that the whole entire country is going to feel the effects of. Versus if we start tackling it, yes, there's going to be an employment, but would you rather have a couple million people maybe out of work or feeling the effects of, okay, like things are getting real, or the whole entire nation? And it just kind of goes to show that a lot of people, they're not very familiar or aware of just basic macroeconomics. We can't have massive money printing and then runaway inflation, expect things to be okay.
It makes me wonder if our senators and our Congress people understand it. Like, I saw that back and forth between Elizabeth Warren and Jay Powell, and it was cringe. There's no other way to put it. It's like, does she know what's coming out of her mouth? Does she know what she's talking about? And I saw a coordinated effort from the Democrats to attack Jay Powell. And in my head, I'm wondering, is there going to be pressure that's put on Jay Powell to be removed from the head of the Federal Reserve because they're upset that he's rugging the economy that the politicians created? Tomorrow, they could vote to end the Federal Reserve if they wanted to, but they're blaming all of their actions on Jerome Powell. He's like, dude, I'm just here to try to keep things under control here and hanging on by a thread.
Exactly. And he's faced with probably one of the toughest decisions that, a Federal Reserve, chairman is going to have to make in like literally decades. Because you're having a banking crisis where banks are going under, but at the same time, you're now faced with runaway inflation. And it's like, okay, what do we do? Do we protect banks? Do we protect investors? Do we protect regular day people? Or do we have to get a grip on this inflation? Because if we don't, like, we are running a risk of where the United States dollar is going to fall because it's just so overinflated. And, Alex has been talking about this as well, where the US is still the world reserve currency. And that is the main goal and the main strategic stronghold that the US wants to continue to have, is that everyone is going to trade in the dollar, transact in the dollar, everything, right? But when you start entering a realm where you're trading in an inflated currency, other countries are going to start to look into other ones. I mean, we just saw what happened to China and Russia, right? They agreed that they're going to be doing a lot of their trade in the yuan with like Latin America, right? In Asia as well. That's pretty scary stuff. That is very scary stuff. And the US is, I think they're starting to become aware that, okay, we're having like these BRICS nations, Brazil, Iran, the Saudis now, they're starting to get away from, the petrodollar. They're like, okay, let's get back on the gold standard. Let's actually, trade amongst ourselves in India too. I mean, India is going to become a powerhouse in the coming years.
Yeah. And the issue is, I think these people are dabbling in different sorts of different types of ways to remove themselves from this infected system. It's rotten. It is not sustainable. And people are trying to position themselves to be able to sustain whatever's coming. If it's not this go around, I don't see how this can't get destroyed here in the next 10 years when this next bubble is created and inevitably pops. People say, oh, the Federal Reserve exists to reduce inflation. No, the Federal Reserve exists to divvy out inflation at a constant rate of 2%. And that adds up over time, especially when the centralized planners come in and they increase the interest rates or decrease it. And they don't rely on the collective decisions of millions of people in the market to determine where the market goes. If you replace millions of decisions with a few, this is the byproduct. This is what we're dealing with.
Yeah, well, I mean, we still don't really know the long-term effects. We're just feeling of, we're only just getting a feel for what is actually, now happening with the crazy printing that we did in a very short period of time after COVID. Inflation can become a very real thing. We've seen it historically, not only here in the States, but we've seen it in other countries. And the fact that you have something like the United States, which is, the superpower of the world right now, that it still has inflation. They're saying, 6%? I think we can all agree it's much higher than that.
Yeah.
Okay? The fact you had a dozen eggs going for like 10 or 12 bucks literally last month or 2 months ago, says everything. What was it, dollar? I remember, like, what was it? I think late 2021, or back in even early 22, Dollar Tree started raising their base price to $1.25. They were saying that they were accounting for inflation being 25%. You know, that's what they were accounting for. You know, the EU, like their inflation is still super high, and they're just still kind of doing 50 basis points hikes. Like it's still very scary out there, and unfortunately, the markets are still very irrational. They're not per se focused on inflation because the markets are forward looking. They're pricing in that inflation is going to get handled, but we're still giving money to Ukraine. Thankfully, I mean, I agree that we did raise it 50 basis points. I think that was the right move. If anything, I think Powell should have probably done higher. He should have done 50 to make a point.
The point that I was making was like, okay, 50 basis points, if that's what it was raised, that would make me feel really comfortable. Because what that tells me is like, hey, everything's good. The economy's not going to collapse. We're going to stick with our plan, 50 basis points. Now, 25 basis points. Okay, it's not as good as 50 basis points would have been, but we're not freaking out. Now, if he had paused or they had decreased, that would have been an absolute red flag, nightmare situation.
Yes.
We are on the brink of destruction. So 25 basis points, I think that splits the difference pretty well there.
Yeah, Johnny's made a lot of posts about this, you know, looking back historically every time, you know.
I need to follow Johnny. I need to follow.
Yeah, make sure you guys get Johnny a follow too. He's been a little busy, but yeah, he's put out a chart. I wonder if I'll be able to find it here, but yeah, it just goes on to show every single time that you know, the Fed paused, it's literally at least the next 6 months to a year, you tend to see a very big drawdown in, you know, the overall economy, at least the S&P 500, like anywhere from like a 30 to 40% drop. So yes, I do agree with you as well that like if we did see a pause, then that means that this whole banking thing is a lot worse than people are being told. That maybe, you know, when Jen Kramer is tweeting that JP Morgan is a fortress, that means like even JP Morgan is about to go under, which if there is a reality where that happens, then I mean, we're talking the collapse much bigger than 08. It would make 08 look like a firecracker, you know? So yeah, if there was an actual pivot or pause, that would have been very scary.
Yeah. And you would have seen the degens go crazy.
Yeah.
And the market probably would have pumped in the short term and it would have trapped a lot of people out there. But yeah, like, you know, we're gonna see, man. Like here's what I really truly believe. I really truly believe that the priority for the centralized banking entities right now are to do away with crypto, replace it with the CBDC.
Right.
And I also truly believe you got to think about what entities across, we'll just take the United States, for example, what entities across the United States are those folks who are backing the most small businesses, and that's small community banks. Okay.
Yeah.
And regional banks.
Yeah.
Now, in terms of centralized planning, they want more control. They don't want less control. They don't want to give those decisions. They don't want to outsource them to localities. So I think that they want to destroy crypto first and foremost and replace it with whatever rendition that they have. And I also think they want to destroy retail banking, because if they can keep retail banking under their purview, then they're going to feel like there's less risk out there. And this is just the behavior of a centralized planner. So I think that we begin to see a lot of small banks actually close down, replaced by bigger. Now, we saw this in education as well. We saw the government gobble up the student loans, right? We've seen this we saw this in the bailouts with the automotive industry. The government gobbles that up and they bail those folks out. So we see this centralization occur. So we'll see, man. I think those two things are on the priority list: crypto and in retail banking. I think they want to do away with in the long run. Yeah.
Well, I mean, we're seeing that with Operation Choke Point.
Yep.
It's many people aren't aware of it, but you know, the whole Signature Bank situation where you even had some of the board members saying that we really weren't insolvent. Like,
correct.
Kind of came in and said, yeah, the fact that you guys are so exposed to crypto, we're going to have to shut you down. Which, again, you know, if you don't have a tinfoil hat, that's okay. But you know, we're kind of at a point in 2023 where it's actually it's almost too difficult to start denying the truth for what it is. You know, really changed things up when Elon took over Twitter and basically allowed complete freedom of speech and transparency. You know, I made that post yesterday where on TikTok too, where we're having our own government come out and say, we don't want a ceasefire in Ukraine. Keep it going. They're basically saying we do not want a ceasefire. Because what do we know? I mean, we're getting a little off topic, but the U.S. is a war machine. This is how we make money. And business is business. Historically, every time that the U.S. gets into any kind of economical issues, it's shortly followed by a war, or there's a war that is already on the forefront. Same thing happened around the Vietnam era. World War II is a prime example, right? Late 90s, Desert Storm, what happened, then the dot-com bubble followed. So yeah, there is a big centralization and control factor, like you mentioned. I was going somewhere with this, but go ahead.
No, it's good that you point this out, because regular people don't really catch on to this. If you're a government and you have access to unlimited money, how is this going to affect your decision making? Okay, so let's just say you didn't have access to unlimited money and a vote comes up to go to war with somebody. Are you going to be more apt to go to war if you don't have unlimited money? Or are you going to be less apt? You're probably not going to go to war if you think that there's a chance that you can't pay for it. You probably will go to war in a much easier way if you understand that you can just print as much money as you want to keep the thing going forever. So that's one example of how our current economic system, the Federal Reserve, kind of skews things and screws things up, especially when you get imperfect humans involved that are greedy, that are selfish, that want to put pork in these bills to kick back to their districts, and they know they can pay for it just by pressing a button. Imaginary internet made up money. That's what we're dealing with here. And you can take that to every realm of society here. You can take that to education. You can take that to unions. You can take that to social programs. If you can just keep printing money and you never have to deal with the problem, you keep kicking the can down the road, eventually really, really bad things happen. Now, really, really bad things happen to who? It happens to the people on the backs of this. You can put Rags Rich's crypto.
Oh, right. Okay.
Yeah. That should pop up. There she is. Yeah, all that. Yep. So see, that's the crazy thing about this. The simple fact that there's access to all these funds, it's like giving a drug addict unlimited money. They're eventually going to kill themselves. And this is what we're dealing with right now on a very large scale, governmental scale.
So, well, I mean, do you think there should ever be any type of I guess involvement, or do you think there should be a point where the government can step in to fix things, or are you under the belief of complete laissez-faire, where it's just literally
no, not complete laissez-faire. If you look at the Swiss economists, if you look at just people who are on the sidelines, like Ron Paul, for example, if you look at Milton Friedman, these folks believe, Milton Friedman believes in a small inflation rate. He believes in 2% inflation rate, but he also believes along with that you have very, very limited government involvement in these things. Most of the economy should be 90% of the economy should be market driven. And we're not seeing this right now. So I don't believe in complete anarchy, government absence, laissez-faire, free market stuff. I do believe that the government has to be there to help. What is inflation anyway? If you have limited government and you have a small inflation rate, it helps the economy expand because you're going to have access to credit. That's just the bottom line. Okay. So that helps expand the economy. It helps expand the government. Yeah. Not government, but the economy primarily, if you're doing it right.
Yeah, I'm just catching up on chat here. Richard Gallagher said, "What's up, Randy? He's trying to get some land in Texas. Where would you recommend for somebody to get some land in Texas?"
Dude, I don't know, dude. I was looking at South Texas, 180,000. You can get about 10 acres. You get a 6-bedroom house with a pool and nobody around you. So
but
you might need an AR-15 that close to the border. I don't know.
Hey, that's all right. I mean, we're talking about Texas here, but yeah, I mean, down in South Florida, you're not going to find anything for 100K. Maybe a dumpster right now.
I know, man.
It's getting pretty bad. And yeah, the crime is starting to get pretty bad too. Because with now spring break season, a lot of spring breakers, there's been a lot of shootings on South Beach, and they basically had to implement a state of emergency, curfew. Yeah, it's getting bad down here too. the name of the game is get some land, get some property, and start becoming self-sufficient. It's getting scary out there.
Yeah, you get through your younger years and you start understanding what's important. You're like, shoot, I'm past my 20s now. Now I got to be on this earth for another 40 or 50 years. I
Yeah.
better figure it out.
Exactly. Exactly.
Yeah, good to see facing reality. I recognize old facing reality. I got to do it for him. Hold on. Boom. I always do that for him. Crypto Compassion, what's up, man? Nice to have you in here. Brightline, I see all these people. David, what's up? Godfather, what's up, man?
Yeah, man. Thanks for joining, guys. Thanks for following Brandon over here too. So yeah, we're gonna be live streaming the whole meeting. Hopefully they can. I want to see what Jay Powell's gonna come out. Is he gonna come out firm, or is he gonna come out a little nervous? It's always.
Well, he's got to be. So this is the first time where he's actually gonna have to face the facts. Like we had massive problems in between these past two meetings.
Yeah.
So now he's gonna have to admit it, and he's gonna have to face it. I'm like, his speechwriter better be good. It better not be Chat GPT-4 either, because he's got to work this real well.
Well, the biggest I already know, like the first couple of questions when they go to the floor is going to be like, okay, what's going to be the strategy and the goal now with the reserve that we're having a banking crisis?
Yeah,
like that's what they're going to be asking about. Like, okay, do you see more banks going under? Or are you going to they're probably going to ask about the 300 billion that they added. So they're going to be asking these types of questions, like, are we going to be getting some sort of injection again into the banking system? Like there's going to be some very big deep questions that are going to get asked that ideally is going to give us an insight as to what they are thinking about just long term. Because again, these interest rates, they're going to start catching up. Like they already are catching up, and we're just seeing a very small blip in just unemployment, delinquencies. Like towards the end of the year is when things are really going to start to ramp up. If they continue to raise interest rates for this long, I mean, we're going on almost 2 years at that point.
Well, dude, think about this, man. Like, okay, we thought it was bad when the jobs report came out, and it was really good. And we're like, all right, guys, watch out. This is a problem. People are going to have more disposable income. They're going to go spend more. The economy's going to grow. They're trying to rug us. Okay. So what's the problem now? Okay. The Federal Reserve just gave a 1 week window to a bunch of banks across the United States to inject $300 billion into those coffers, which they're going to use that money, and they're going to, lend those out to try to stimulate things and keep things even keel. It's like, they are not in control of the situation whatsoever. And it absolutely blows my mind here, man. So that 300 billion is going to have an effect long-term, lagging indicator, maybe next couple months. We're going to see them trying to fight that 300 billion that they put in.
Yeah. Well, and I also want to see what a lot of like these influencers, especially on Twitter. I don't know if you were, when SVB first crashed, like Mario Nafal was doing like that crazy long Twitter space like the whole weekend. I mean, pretty much every single one of those guys in there was like, yeah, they're going to have to pivot. They're going to have to pivot. They're going to have to, they're going to have to go into QE to save the banks. And that narrative really started flowing around. And that is partly a reason as to why we're, seeing a big uptick in, Bitcoin itself. Because a lot of people were expecting that, okay, there's going to be a pivot or a pause, and this is just going to open up the floodgates again. So now it's going to be interesting to see how they are going to explain themselves for the past 2 weeks. Well, I guess they did have to raise it, but I think that they should sort of pivoted or something.
Dude, the thing that I dislike the most about crypto Twitter is their inability. It's their ability to look at what the facts are and completely dismiss them.
Yeah.
And I think that's partly because, you want to be the first person that's right. So, and you want to try to look like a prophet on crypto Twitter.
Yeah.
But really, if you just take a look at the facts and you actually listen to what they're saying and compare it to the charts, you can make pretty good decisions about what's going to happen. The number one priority here is us not getting runaway inflation. I made a post the other day about the Zimbabwean dollar. Okay. When they went into a period of hyperinflation, this happens very quickly. Every single day, every 24 hours, the value of their currency was losing 50 to 90% every 24 hours. That means a cup of coffee today that cost $1, if it gets out of control, a cup of coffee costs $1 today, and in 2 weeks, a cup of coffee costs $100,000. So it's like inflation is a very, very serious thing. People aren't taking this seriously. You have the progressive left, the Democrats in Congress saying, hey, we need to just cut this. We need to just let the market solve all the problems. Well, thank you for saying that now. It's a little bit too late. Let the market solve the problems. You guys don't really believe in that. So it's absolute turmoil. If you guys have not read the book In the Fed by Ron Paul, it's probably the most important book that anybody could read, and it's very digestible for the average user. It explains in detail everything that's happening right now. And this was actually predicted 75 years ago by a lot of folks smarter than myself, for sure.
Sure. We got Will in the house. What's up, man?
What's up? What's up?
I don't know if he's still at work. He says he's going to take it a lunch, but yeah, we got Will Mooser in the house, guys. He's got a Discord channel. I'll put the link to join as well. He's been, me and Will have also been going back and forth with a lot of the irrationalists that we're seeing in just the good old Twitter spaces. It's pretty scary how everyone can become a macroeconomist overnight. I think he has to rejoin. He was having audio issues, but yeah, I mean, everyone just kind of became a macro guru overnight. Now, in hindsight, if we do kind of take a step back before this meeting starts, when Bitcoin was first created in 08, 09,
yeah,
it was basically created for this reason.
Right.
When banks go under, people don't have their money trapped in cash. They don't have their money trapped in banks, and we are still going to be able to barter, trade, consume peer to peer, right? We're just going to have a different form of currency. So technically, as of right now, yes, this is like the environment where Bitcoin is supposed to prosper and go ballistic. I mean, that we had now the whole thing is with Balaji $1 million per Bitcoin. I want you guys to take a very simple math equation here. Take 21 million, because that's the amount of Bitcoin that are ever going to be out there, and multiply that by $1 million. Do you know what you get? You get 21 trillion. Do you know what 21 trillion is? That's the overall debt deficit of the United States of America. So we would literally have to have all the debt in America go into Bitcoin right now for it to hit that $1 million mark. Now, people are gobbling it up. They're saying, oh my God, yeah, we're going to get $1 million Bitcoin. Where is that money going to come from? We can print it, but then you destroy a currency. So where is $1 million per Bitcoin going to come from? And nobody can answer that. They just think that automatically everyone is just gonna pour their money and their assets and resources into Bitcoin. Okay. There's a reason that Brandon's not fully in Bitcoin right now. There's a reason I'm not all in on Bitcoin. And I think the last thing that a hedge fund, an institution that has tens of millions, hundreds of millions, not billions of dollars, is going to pour all of their cash and all their liquid assets into an asset that can fluctuate 10% up or down. That's too volatile for them.
Love it, man. Here's another thing. Everybody says, all the institutions are going to pour in and the nation states are going to pour in, and that's fine and dandy, but that's not going to happen until we've really flattened out the S curve here. So, we'd have massive fluctuations, massive volatility in Bitcoin throughout its entire life. But in order for them to really adopt that, like you said, they want to build business products on top of Bitcoin. They want faith that it's going to be the same. Here's our boy.
He's got the blue tie on. What does that mean?
Dun, dun, dun.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy. These actions demonstrate that all depositors' savings in the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal.
Still the same goal.
Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate.
Can't hear you, buddy. Can't hear the stream.
Yet the labor market remains extremely tight.
Is it muted again?
Over the last 3 months, the unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025.
Wow.
The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy.
2 more years to lead to the 2%.
Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets.
Yeah.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point,
wow.
bringing the target range to 4.75% to 5%.
Getting crushed.
And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally
Interesting,
come in
dollars dropping
stronger than
too.
expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond.
Gold up.
As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025.
It would barely lower it.
These are a little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Wow. Here we go.
We'll get 20 bad questions. We'll get one good
Financial
question.
Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected. And really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December.
Crazy.
December meeting.
Look at gold.
We are committed to price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring.
That's why I pointed that out. I knew gold was going to pump off of that, off what he's saying.
It's important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused as always on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing.
Guy always likes to play head fake games
We
with his questions.
clearly were, what we were doing there was taking.
He
on
tries to
board
make things seem
kind of
more bullish than they actually are.
about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time. And in principle, if that means that monetary policy may have less work to do. We simply don't know. So
Your concerns that the hike you did today could further exacerbate the problem in the banks?
no, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation of the banks, we're focused on our financial stability tools, in particular, our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting, but I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do. And that therefore they were including that in their assessment. And that if that turned out not to be the case, that in principle, you'd need more rate hikes. So some people did reflect that in their SEP forecast. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermediate period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system open market account as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Hi, Victoria Guido with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so. They're going to lead it in his capacity.
So you can just cut out
I
again.
don't, my role was to announce it,
You guys still there?
and
Yeah.
I get briefed on it, but I'm not involved in the work of it.
Chair Powell, Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes, I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly.
Marty, I got
than we
another
would have
stream to
liked,
hop
but it's
on.
certainly proceeding.
I'll talk to you soon.
Housing
Thanks,
services
guys.
is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is that's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk. Didn't hedge that risk.
Oh,
We
you
now
admitted
know
they had a
that
bad
supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So for us, for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. You know, I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week, so, but that will be up to him. So that's really where it is. You know, the review is going to be thorough and transparent. It is clear to your last question. It's clear that we do need to strengthen supervision and regulation, and I assume that you know, there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, just and the final point. You know, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, you know, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline.
So zero rate
If I could
cuts.
follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from, tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Go to Rachel Siegel.
Hi, Chair Powell.
Last
Rachel
question,
Siegel
guys,
from
and
the
we'll
Washington
wrap up.
Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing
What's that?
concern that there are financial stability risks from the commercial
so we'll
real
listen
estate
to this last
market
question, and you
and
and I will
loans that
chime
will
in.
begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
And one other question, would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome when a bank fails, there are investigations, and of course, we welcome that.
This is not good.
Thank you, Mr.
Yeah, they're
Chairman.
better.
Edward Lawrence from Fox Business.
This is
Inflation
bad.
has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I can follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
You know, if you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3
This is a good
seemed
question.
like the right. We have a little more flexibility.
Amazing
under Section
question.
13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
It's a loan, not QE.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end?
No,
Thank you.
absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor.
He's literally saying everything hawkish you
We're
can
going to
say.
be watching to see what that is, and we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we
Look
will.
at these people; they're just like
we will
pouting in the room.
Eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle
right, let's
Campbell,
see
the
what they
American
ask you.
Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working.
There goes the big
In terms of the
memo.
distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run
What happened?
off
Oh, Bitcoin.
predictably
Bitcoin's
and
gonna go hard
passively
on this.
is working.
No QE.
And
Yeah,
of course,
that's bad.
we're always prepared to change that if that changes. but
Basically,
we
you
don't
have
see
to
any
be a
evidence that
certain
that's
meet a
changed.
certain requirement to even get the money. He said so. It's like basically just money that's sitting there that can only be accessed under
Chair,
specific.
Katerina Saraiva with Bloomberg News.
Yep.
The minutes of the February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's been quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise.
Take a look at bonds real quick.
I think, as you know, as it is now on the public record, the supervisory team was apparently engaged,
A little bit of
very
sell-off
much
after a
engaged
big,
with the
huge
bank
buyout.
repeatedly and was escalating. But nonetheless, what happened happened, and so that's really the purpose of
Bonds dropped
when I
hard.
think
Oh
about
my
the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is
There you go.
you've
Bitcoin's
seen
really moving
that
now, breaking
we
that
have
trend
the
line.
tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume
All I
that
can say is
their
people were told, man.
deposits are safe.
It's a lot of FBGs on the way
Thank you,
down.
Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well. So far.
Nicole. Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And I mean, there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, I'm sure you have, you can see that if the central bank doesn't get
I'll break that
inflation
down for the normies
back
real
in
quick.
place, get
He
inflation.
basically just
make
said
sure that
2% is the
inflation
goal. He doesn't care
firmly
how much
anchored.
things break.
You can have a long
basically what he
series of
just
years
said.
where inflation is high and volatile,
crazy.
and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that. And
it's all the same
and to
stuff.
get back to where we need to be, back to where we were for a quarter century.
He doesn't care. He's basically just stated that. He's like, hey, 2% period.
Yes, sir. Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. You know, the models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's what so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, you know, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the
Damn,
people we
Bitcoin
serve.
not liking
That's
it.
how we can have a long, you know, we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have
Well,
been
you got to consider,
really
I did tell a
since
lot
the
of
high
people here,
inflation
I
period.
asked, like,
And the
they
reason
don't,
was
but-
inflation
I was
wasn't
like,
forcing
I
the
already knew
central
which
bank
direction
to
this
come
was
in
gonna
and,
go.
and stop
So many people try to
an
argue with it.
incipient or
Yeah, we'll see how far down
an
we go.
expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean. Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
You know, it's too early to say really whether whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been
Before it went from, we're going to have a
changes in
soft
that, you
landing
know.
to now it's too early.
The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and you know, we're certainly trying to find it.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, in particular immediate attention. That's and I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. You know, what can we do to make sure? But again, that's not for me to answer today.
So you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, you know, this review is going on. And, you know, I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. You know, it just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, you know, to this work, not connected to this bank. and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Oh, that's going to be bad. He's basically just literally shit
Thank
talking.
you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I have to say. So, thank you very much.
All right, there we go, guys. The man himself, Jay Powell. So, what's the takeaway? Rate hikes, it's still happening. Interest rate hikes are still happening. They're not taking their foot off the pedal. So stop believing all this pivot narrative. He's been very clear, guys. He's been very, very clear. Will, what are your thoughts?
I mean, there's a lot of takeaways there. Obviously you said 2% inflation is a goal, period, flat out, nothing else, only 2%, that's it. Unemployment, he already said again, employment is way too high. He's saying that the hiring market is way outweighing the amount of available people. So what that means is that for people normies that don't understand, and I think this is what we come across a lot of echo chambers speak of, people just don't understand what they're talking about. But basically, when employment balances with the amount of employable people, then you are at a rate of where consumption is equal, right? When employment, as far as companies needing to hire people, outweighs the amount of people that are available to hire, at that point you are beyond consumption levels. Your consumption levels are high, right? That's why they need more employees than there are available employees. And that's what a lot of people aren't able to connect the dots on, is they're not able to connect the dots on, you need employment and the amount of employable people to be kind of on the same level, because that tells you consumption is even at that point. That's the biggest takeaway for me that I think he's looking at, and that a lot of people are ignoring. The other thing is too, is like, he brought up quite a few different points, basically stating, in my eyes, the way I see it, whether he come out and said it outright or not, that SVB was completely illegitimate and run the wrong way. He basically stated that it was a criminal organization at the end of the day. And
Well, again, like you said, the goal is still, inflation, and there's way too many jobs. Again, like, interest rate hikes have been going on for a whole year, guys. Like, we basically started this time last year. We started slow, we ramped up to 75, and now we, ramped our way back down to 25. And we haven't really seen per se, or I should say the Fed hasn't really seen what they wanted to see, which is unemployment going up. That's how they base in the job in the overall economy, but mainly for jobs. Like, they're seeing that there's still a lot of jobs that, economies went down. Yeah, there's been a couple of banks that have went under, but like he said, it's nothing that is worthy of them actually doing a pause or a pivot. He did say that, yeah, they considered it, they talked about it, but inevitably they were like, it's just not enough for us to say, yeah, we need a pivot or pause. And then a lot of the questions were also, oh, well, a lot of the projections that you're going to keep hiking till May, and then you guys will take your foot off the pedal. And I mean, some of the charts, I don't know when you guys joined, but some of the charts that they were showing, like, they were showing that core PCE inflation, it wouldn't hit its 2% goal until 2025. Until 2025, guys. The Fed's terminal rate right now is 5.1% by the end of the year. That's as of right now. These terminal rates change, every single time that there is a report. So the gist is even though like it seems like everything is falling apart right now with these banks, that it's kind of like a drop in the bucket, unfortunately.
Yeah, I would add to that too. Like a lot of this, it's just something that has to happen in markets. You get a FOMO mode market where the market's basically over leveraged, just too much going on. And then you need to wash out those bad actors, and that's what this does at the end of the day. A lot of people are like, you don't have to. It's like, yeah, you do. You have to wash the foam off your mouth.
So Simon in chat there, he was, we were chatting about it. He was saying that he's calling it cap, that the the failure of the bank was an outlier. I mean, I don't think that it was an outlier. Basically, what ended up happening was, again, a lot of banks, because since 2008, there's been so much QE. A lot of banks just took on way too much risk. They got greedy. Guys, it's the same story over and over again. These banks, they get greedy and greedy and greedy and greedy and greedy. Why is that? Because they know that if something happens, the execs, the ones at the top, they're going to get away fine. There's going to be some loss, obviously, people's monies, but inevitably they're banking that the government and the feds are going to step in and save them, because that's what's happened historically. And me and Will had this chat about it, especially right when Silicon Valley was happening. Like, guys, bailouts are going to continue to happen until we reach a point where bailouts no longer work. Like, you can only do the same trick so many times until it loses its appeal and loses its zing. So far, and to this day, bailouts are still working. Now, granted, people are a lot smarter now, right? They're starting to understand, okay, if things get bad enough, the banks will get bailed out or whatever. But the regular investor is starting to understand that, okay? And eventually, the U.S. is going to reach a point where they're going to be like, we can't bail you out because we just can't print any more money. We don't have any more money. And this is why what's happening right now is like so crucial and so important to watch, because now the U.S. is somewhat entering a territory where it's like, okay, they got crazy inflation right now, so they can't turn the money printer back on because everything that they did for the past year would have just been a waste. But at the same time, they do have to understand and research how bad this contagion is, because, I don't know how many of you guys are on Twitter and know about Inverse Kramer. Jim Cramer did tweet, JP Morgan is a fortress. Imagine a world where JP Morgan collapses. I do believe that like half of their deposits are actually FDIC insured, but just imagine a world where a giant like JP Morgan collapses. That is, and Brandon and I were talking about this, that is a world where, that very much could undermine the entire country of the United States and the overall dollar. But what I'm trying to get at is like the Fed is in a very tight spot, but they're still picking their overall goal, which is we have to get inflation down. Inflation right now is greater than a couple of these risky banks going under. And once we start kind of entering the territory that now we're risking serious financial institutions, we're risking serious losses, then that would be a conversation for us to maybe pivot. But ideally, by then, inflation's already come down a lot.
Yeah, I wanted to kind of touch base too. Like, I think a lot of people miss the fact when he basically states more or less that the...
No, go ahead. Yeah, I'm talking to TikTok. Sorry.
Oh, my bad. I was like,
no, you're good.
So, I was basically wanting to state, like, more or less, like when he's sitting there stating about the bank, when he spoke about the bank, you got to listen really closely to what he said specifically, right? He basically stated the bank was not run correctly. These are bad actors when it comes to the banking system. He recognized that, stated that, and basically said these are basic criminal organizations, essentially, right? These are organizations that over leveraged and did stuff they shouldn't have been doing. And there will be more of those, and people need to not panic on those type of moves. Those things happen. In every organization, I mean, think about Enron. Nobody thought Enron was a Ponzi, right? Everybody thought Enron was a great company. It's going to do all these things and everything else. You never know which empire is actually built on, a house of cards.
Yeah.
It's ready to blow over at any moment.
Exactly. I mean, look at this now coming out. Kraken is no longer going to support bank deposits and withdrawals starting on the 27th. That's kind of crazy. So it says beginning March 27th, you'll no longer see a deposit option via Plaid or withdrawal option via Silvergate, and other services will be affected, including instant purchases via online banking. And it looks like what they use is something known as MVB Bank for Fedwire deposits and withdrawals. But yeah. I mean, this isn't necessarily per se like crazy news, because like obviously Signature, has gone down, but yeah, they're no longer supporting banking, direct deposits, which is, again, we're starting to see like the ripple effects of interest rates and some of these banks going under.
Well,
so, yeah.
you heard about Coinbase too, right?
Yeah, they suspended Algorand rewards.
Well, not even that. Coinbase is actually, and a lot of other crypto platforms are actually looking to use banks more in Brazil. Why are they looking to use banks in Brazil? At the end of the day, what are the requirements for banks in Brazil that that they would be eyeballing that place specifically for banking? There's just a lot of concerns with the direction that a lot of these things are going and stuff like that. It's like, why would you not look for another U.S. bank if you're looking for trustworthy capital?
Well, because this is where Operation Choke Point comes in, because the government is also trying to attack crypto banks specifically because they want to choke out the liquidity out of crypto. So that's probably why Coinbase is having to go that route. I mean, again, Silvergate just got hit. And you and I talked about it, where that one board member came out and said we really didn't have any insolvency issues. It looks like they specifically targeted us because of our exposure to crypto. So again, that's a whole other theory and conspiracy that a lot of people have done deep dives on. I've done it as well. I mean, there's a lot of like information that circulates about it on Twitter. But I mean, things are getting a lot more bigger than crypto right now. Like, we're having banks go under, guys. So, I mean, going forward, be very cautious and wary of, all these people trying to predict what the Fed's going to do. Again, the last 2 weeks, we've been not only hearing pivot, or not only hearing pause, we've been hearing pivot, that the Feds are going to, lay off the gas. And again, once again, they've been proven wrong, because
don't forget rate cuts. That was another one that people were predicting for this year. It's not going to happen. He said the market is completely wrong on that.
Exactly. So people need to stop fighting the Fed, because again, inflation is their main goal. So if that means some banks going under, if that means unemployment going up, if that means people losing jobs, businesses going under, so be it. Because unfortunately, that's the ugly truth of getting inflation under control. You can't, it's kind of like when you eat a lot of candy, right? You can't eat all this sugar and all this candy and not expect to have a bad side effect, right? Whether you have a bad crash, stomach ache, whatever, cavities. That's exactly what just happened. We had all of this, sugar basically come in during the pandemic with money, all of this leniency. And what happened? People took advantage of it. Businesses took advantage of it bigly. They, it's that expression, you give somebody an inch, they take a mile. Well, we took big miles, okay? And now the brakes are coming on, and they're coming in hard, and people, they've just been kind of like, these businesses have just been in like this, all go mentality, and they never thought of a world where there could be like a slowdown, and now it's happening. So we're seeing the effects of it. The Fed's job isn't to make sure that all businesses are okay. Their main job is price stability.
Yeah, I kind of think it's more like people went out to party, got drunk the night before, woke up the next day with a hangover, still felt sick a week later, found out they had they had issues with their liver too. And it's like, the symptoms just keep getting worse and worse and worse. And what it's going to take is they just have to stop drinking. That's all it is at the end of the day, right? They just have to stop drinking. And that's what a lot of people don't realize. They don't want to stop drinking. They want to keep drinking. But it's like, if you want your liver to heal, you got to stop drinking. So we got to soak that liquidity out of the market. Not we, but like that's what the Fed's intentions are, is to soak that liquidity out of the market. And a lot of people just are not willing to accept that. They just can't accept down, right? The permables, and I say that permables not in an insulting way to be able, but it's more like you have to be flexible with the market. If you're not flexible with the market, you're going to lose a lot more than you're going to win. yeah, you could say I held for 7 years or 8 years, but think of how much more profit you would have gained if you would have taken advantage of these pivot points in the market and then, bought at a lower price. It doesn't even have to be the bottom. It just has to be lower than where you sold.
Yeah. Simon said that, Coinbase solicits certain trading pairs like OMG. Yep. So which banks are next to fail? I mean, it's going to be banks that have literally the majority of their deposits uninsured. And, a lot of these small banks that, were very lenient to small businesses, probably startups. They took on just way too much risk. These are going to be the next banks to get washed out. The big ones, they're smart. They invest in long-term treasuries. They invest in actual assets, like gold and silver and platinum, stuff like that. Obviously, was it JP Morgan just came out that they found out that they had rocks instead of silver, right? So that's going to be interesting to see unfold. But yeah, I did want to finish the stream with just like a little Bitcoin price prediction or just the overall thoughts of it. So, I mean, typically FOMC, you're going to see crazy volatility like this. You get a crazy wick to the upside and the downside. It's never really ever smart to trade FOMC because you're either going to get liquidated or get caught on the wrong side of the trade too early. The gist is this, we've had a crazy run up really since the new year. I mean, this is where it began, literally January 1st. We ran up 75%, which is very crazy in this market condition right now. And, we did have obviously a decent pullback here. This is when, Silicon Valley Bank was happening. And then the whole narrative of, okay, people are going to flee to Bitcoin started to arise, that the Fed will pivot. And as we can see, that has been, debunked yet again. So especially after this run up, I mean, we're due for a pullback, a decent pullback at least. I think that, anywhere like the 26K range is pretty good. And then, if things do get bad enough, then, right around here, this is like 24, 25K. So that's kind of what I'm eyeing for Bitcoin to come back to. And then from there, again, it's either, people are either going to start taking profits very heavily and start shorting the market, or they're going to start looking to, pack in some more bags. Maybe Bitcoin kind of pulls back here, but then Ethereum and altcoins have their final surge and rally because we haven't really had an altcoin season as of yet. We're starting to see some alts starting to bleed right now, but yeah, I mean, we're due for a pullback. So you got to remember is that, like I mentioned, FOMC, it's always a lagging move. It takes a couple of days for the market to really digest and understand what just happened. I mean, S&P 500, it's broken this trend line. We kind of did come up to that 420 level back in February, but I mean, if you just want to draw a simple trend line as well for S&P 500, I mean, it's been on a downtrend, right? It's still a downtrend. You could say that, we did briefly break this trend here, right? We broke that trend, came back, tested it, kept testing it, maybe having a bounce out or a breakout, but nothing's really confirmed. But on the broader trend, I mean, this is still a downtrend, okay? And this is very simple, guys. Don't need to get fancy with it. Will, what are your levels for S&P 500? Because I have like these gap. I mean, I don't know if we'll come this low back to like the low 300s.
I think 360, potentially 3,200. That's kind of where I've been eyeballing price.
Yeah. 360s at this level right here, guys. This is kind of like these are like the lows of October. So maybe back down to these levels, but yeah. So again, the name of the game, guys, don't fight the Fed. We're not going to outsmart them. Jay Powell has been very clear too many times. It's really sad that a lot of people keep trying to predict that he's going to do something else. Again, no one here is a macroeconomist guru. These guys, like, they know what they're doing, and inflation is the number one goal. So just understand that. Understand that you can make money on either move. You can make money either on an up move or on a down move. All right, you just need to develop the skills of actually learning how to do that. You guys can go join Will's Discord as well. Let me put the link in chat for those of you that are maybe new to Discord. I guess my Discord doesn't want to load up here. But yeah, for those of you guys that are new, go check out Will's Discord. You're like making announcements like crazy. And I do believe I have a link to a free coaching group as well in my description there, guys. So you can check it out as well. But yeah, well, I guess any final thoughts here?
No, I mean, people just need to be cautious. Obviously, when you're setting that resistance high, be back there. When you're setting at resistance highs, it's not time to buy. When you're setting at support lows, that's where you can go in. Just so many people get caught up in the FOMO. A lot of the time, it's The noise is just noise at the end of the day. You just got to be really careful about that kind of stuff. So, yeah, just be careful when you're at highs, and look for potential moves when you're at lows. That's basically it. To be honest with you.
Yeah. And again, just don't FOMO, guys. Just again, like we have to understand, market conditions are still bad. It is still very bad out there. We're only seeing the beginning of the crack. The crack is like this is like the small part of the crack before you understand. Wow, this crack is a lot bigger and it's huge, right? If anybody wants to clip that and make a meme out of it, you're welcome to. Yeah, like the rift, right? I'll change the terminology. The rift. We're seeing the very beginning of the rift until you get to the big one. You're like, oh my gosh, like that is okay. Now things are bad. So, yeah,
and nothing ever goes down in a straight line. So people see a bounce, they get hyped up, and they're like, oh, I need to get in, but it's just a bounce at the end of the day. Like if this thing starts dropping, it's going to drop, it's going to bounce, it's going to drop again, it's going to bounce. Like I can really, and this is something I brought up to you before too, Marty, is like I could see this whole run up here for Bitcoin eating itself all the way back there.
So I mean, for instance, like really what's been floating around the last couple of days, it's like, oh, like Bitcoin broke above the 200-week moving average, which we did, it's this purple line. And we actually broke out of it, with speed, with volume, which is ideally, what you do want to see. Let me pull up the volume chart here. Like this is actually what you do want to see when you are breaking an indicator. Now, again, I don't ever like to bet my trading or bet my decisions off of an indicator because, they got invalidated so many times in 2022. However, that was like another big narrative that was floating around. So yes, last week we broke through it, but as we know, you don't want to trade the breakout. You want to trade the retest and the confirmation. So ideally what we want to see basically, up until the end of this week, which is Sunday, is we want to see, if we're going to come down, test this purple moving average, which is a 200-week moving average and hold, or if we're just going to go right through, back down. So we still have a couple of days, it's only Wednesday. We got Thursday, Friday, Saturday. We'll see how the stock market really reacts tomorrow. S&P really hasn't gone down, crazy right now. But there still is like a lot more that can happen throughout this week. So yeah, just watch that's about the 25.5 level for Bitcoin, 25,500, which I think is what a lot of people are eyeing as a retest. So if we hold this moving average, then okay, it kind of plays into the thesis that maybe we'll have that one more final push up to this 30K level for Bitcoin. I mean, we kind of got it up to, what was this, almost 29K. I mean, maybe
look how long we took at that lower portion before we pushed again. Look how many weeks that was. No, down below. So right there. See how long that took to consolidate? That's what you need. And then see that bottom, how you got a line across basically holding all the bodies right there. That's what you want to see if you're going to see another push. So you'll see a big pullback and you'll kind of see something very similar to what we have there. So like people buying here, you're buying the top of the move. You need to see that consolidation move where it sits there and holds, pulls back, holds, and then takes off. That's what you want to see.
Yeah, because a lot of people, they did miss this move right here. Like a lot of people did miss out on, this move from about the low 20s because it was a banking collapse. I mean, better yet, we went all the way back down to 19.
That's the exact price I gave too for the inverse head and shoulders. That is the exact, I gave 19.6 as the exact price for the inverse head and shoulders. So if you'd have taken that on the inverse head and shoulders, that would have been your move right there.
Mm-hmm. And you would have been taking profits basically over the weekend or even early this week. So yeah, guys, so don't FOMO in. If you missed out on the move, it's okay. We are due for a pullback and a retest. We can't just, keep going all the way up to 28K. If we did, that really would have happened last week, which it did. And then as you can see, we're reversing. So there's going to be profit taking, especially after this meeting today. And then again, we're going to watch that basically 25K level to see if we can hold there. Because if not, then we probably will be seeing lower prices on Bitcoin. I don't know if we're going to go to that 10 or, again, I'm always going to keep 10 or 12K on the table. Things do change because now we're seeing more money flow out of alts because of the whole SEC and securities situation. So there is a reality where maybe we don't see a 10 or 12K Bitcoin. Maybe the bottom was around like that 15 to 16K with FTX. Again, that's why it's so hard to do price predictions. You never do it.
To add to that, Marty, so scroll out a little bit. If you draw a line across see how the top's angled right there?
Yeah.
On the bottom side. So just draw a line all the way across the lows. Angled up. No. So angled up.
Yeah, I'm just getting I got the wrong.
Gotcha.
Actually, I'll just do the trend line. This way.
Nope, other way. Yep, up toward our previous lows at when we were at the high. Yep, right there. So if you draw that trend straight down, if we end up coming down, we can come all the way to that trend, basically. So that's what a lot of people don't realize. And the longer this thing takes to play out, that becomes more of a reality. If we end up coming back down, right? Doesn't mean that'll happen at the end of the day, but it doesn't take it out of the picture. I would say it'd be more like a bounce down, bounce up, bounce down, bounce up, bounce. Like it'll roll, right? It'll roll down, but that would be the more ideal position if it were to work its way towards that direction, and then hit the trend, and probably create a bigger trend reversal move off the RSI. But I just want people to not completely rule out that deeper can't happen. It's always a possibility.
Sure.
At the moment, you just got to take it level by level, though. You can't just be predicting, 50K, just like you can't be predicting 12K right now until prices get closer to those ranges. Then you can kind of eyeball the chart and see where that's at.
Right, exactly. Because and as well as, conditions are always changing, depending on what the Fed does. At the end of the day, markets are going to remain irrational longer than any of us can remain solvent. If we had hundreds of millions of dollars to trade, then we could make all these crazy price predictions and in a way kind of manipulate the markets, but we can't. So look, you're gonna have. Look, Bitcoin's making another move there. It's already down to. Here we go. We're getting a decent move on Bitcoin. Something must have.
Yeah, it's probably going to go pretty deep today. Then it'll bounce, sit for a while, make people think that it hit its support, and then drop more.
Yeah, now we're breaking 27K there. And then on TikTok, I'm using fair value gaps as my indicators. But the move is happening now. So alts are really starting to bleed. XRP is down 10%. Tron down 10. So we're going to be geez, look at Tron. Oof.
Oh my! Is that a rug pull? No,
it's on the hourly. So
I know.
Yeah, Tron is due. Look, that was a crazy.
That's
spike.
still pretty massive, man. That's crazy.
So if you guys got in on shorts, congrats. If not, I would wait for probably a bounce there around the 25K-ish big
Check
level.
Matic out real quick.
Oh, the trader has Z coin.
Yeah, let's check it out. Matic. Yeah. Yeah, I think Matic's gonna bleed, man. That looks like a head and shoulders all day.
Yeah, I'm coming down to 80-cent range. That's what I'm looking at, and then
they might even revisit those lows.
Yeah, back at
Matic just hovered too long for too high. You can see the uptrend right there building. You basically got a bear flag, basically bear channel. So if you were to draw a channel towards the upside, like that thing's setting in a big bear flag. And then capture your highs.
Right.
So use the channel tool.
Okay.
Yeah, either one. It could even be that. It could even be a rising wedge. It could be a rising wedge. It could be a bear channel. Either way, it's a down pattern. It's a bearish pattern.
Let's pick up the channel. It's been a while since I used the channel.
Yep, right down bottom. Yeah, you got it. I think you got it. So draw it from your lows, and then click, and then pull to your highs. And if you look there, well, it invalidates if it goes beyond. What are you on, the hourly, weekly, daily? On the weekly. Go on the weekly. Let's see what those highs and lows look like. That gives a better defined move. Yeah, I don't know if that might actually be a rising wedge as opposed to a channel. The way you had it.
Yeah.
A rising wedge is still bearish though. Yeah,
right.
I think that's more of a rising wedge. It's starting to tighten there at the end. It's looking for a big drop, I think. And if it follows the rising, draw the rising wedge real quick. I just want to kind of gather the drop here so we can give some people some alpha. And then draw the high end of the wedge. And then draw that wedge all the way back to where it dropped. Now draw a line straight down the drop from end to end.
Which drop?
Right from underneath the wedge, from the top of the wedge to the bottom of the wedge. Yep, right there where you're at.
Gotcha. And which way do you want the line, from like here?
Straight down to the wedge. And now click and then take that and put it underneath where it's sitting at the bottom of the wedge.
Yeah.
No, other side. The high end.
From up here?
Yeah, but underneath. Now go over to where it's sitting. Right there. That should be your drop. What's that say for price?
40 cents. So yeah, back to these lows of like June lows.
Yeah, that should be your drop. It's typically whatever your inside wedge high to low is.
Sure. Gotcha. So yeah, I mean, this is on the weekly too. So yeah, I mean, I got it coming down to like this 80-cent range for a given.
That'll just be the start. What it should do is probably is that 80-cent range. It'll hit that. It'll bounce back up, retest the low, and then drop.
Right.
If it doesn't retest the low and shoots through that, it'll go deeper than that move we just showed them.
Yeah. All right, guys, we'll wrap it up here. Let's take a final look at Bitcoin. Yeah, 27.2. So yeah, the pullback's happening. This is on the weekly. I mean, the top of this, I mean, there's a lot of probably going to find some resistance right here, which is, right at that like 24.5 level. So yeah, it's going to recover half of this candle at least. And then, just to finish, if we line it up with our moving averages, I mean, ideally, to build the case for the bulls, if we're using indicators, and I would want it to bounce at 25.5. But if we break through the 200-week moving average and we break through with volume, then I think the trend is invalidated at that point, guys. But man, we had like 30 viewers in this point at one point in this live stream, guys. I appreciate it. Hopefully you guys followed Rags to Riches there, and Will as well. You know what? I might start doing some of these morning market updates, guys, and maybe I'll bother Johnny enough and he'll hop on. If not, I'll just do them on my own. Just try to do a couple here and there. Go ahead, Will.
No, I was just gonna say thanks for having me and stuff like that. And
Yeah,
we'll try and get together more on this and maybe provide.
I put Will's Discord there in the chat there, guys. So go ahead, follow it there. TikTok, it should be in my bio as well. So yeah, guys, if you liked it, obviously like, subscribe, share it, push bell notifications. If not, you already know what to do. Leave some criticisms in the comments.